Federal Reserve has only two choices left, and neither of them are good. Now, while the markets are hitting new all-time highs, the economy seems to be getting back on track. People are feeling overall bullish, definitely more bullish than they were before, but underneath it all, there's trouble brewing. The Federal Reserve now is going to be forced to make a choice, one of two choices that has massive implications for the United States and for the entire global financial system. Now, in this video, I'm going to break down the trouble that's brewing. I'm going to talk about the indicators that you need to be watching, the two choices that the Federal Reserve is going to be forced to make. They have to choose between, what it's going to mean, and of course, how we need to prepare, how we need to navigate this entire mess. So stay tuned. All right, welcome back. If you're new to the channel, my name is Mark Moss. Now, I like to talk about the financial system, the need to go back to a hard, sound money. And we really focus on this because if you're not paying attention, it's not going to work out too well for you. At the end, there's going to be two types of people, those that were prepared and benefited and everybody else who didn't. Now, I want you to be on the benefit side. I want to get more people. So if you can take one quick second to help me, click on that like button so more people see the video, and then subscribe if you're not already subscribed, hit the bell notification. Now, one more thing, if you don't stick around to the end, I'm going to tell you how we're going to navigate this, but I am going to host a new training, a live 1 hour training. We're going to dive super deep into this. It's free. There's a link down below in the description. You can click on it, get all the details, and I'll talk more about it at the end. But today we are talking about the Federal Reserve. The United States Central Bank, the Federal Reserve, they are going to be forced to make one of two choices. Now, neither one of these choices are good, but they're going to have to choose one or the other. And I'm going to explain what those are and what that means, what the ramifications are. But today, you have to understand first, before I can tell you what those two choices are, that we're in a debt-based system. So what that means is that all the money, all the currency that we have is based off of debt. And because of that, we need more and more debt, constantly need more debt in order to stay alive. Now, we've gotten to the point where we're spending more money than is brought in. Just like if you lost your job, you still have your bills, but you're not bringing income in. And so that is what is the United States deficit. And this year, in 2021, it's projected to be $2.3 trillion. $2.3 trillion. Now, to put that number into perspective, because that's such a big number, it's being thrown around a lot. In 2008, the great financial crash, the entire world, the entire global banking system almost collapsed. And in order to save the global banking system, the Federal Reserve had to step in and bail out the banks. That was the TARP package. At that time, to save the entire world was $700 billion. Now, at that time, that was an enormous amount of money, and it was like, oh my gosh, I can't believe they're going to spend that much money. But today, $700 billion is nothing. Today, we are $2.3 trillion upside down. Now, a couple things to notice about that. First of all, we are going to need this continually more and more and more. We're going to need it because of the deficit, because of the shortage that we have. We need it because of the stimulus that's going to have to continue to go out. The markets are obviously recovering, but the economy isn't. And so because of that, we're going to need more and more stimulus. And we have the Green New Deal that the new Biden administration is going to be pushing forward, moving towards green renewable energy. And so we're going to have a lot more infrastructure spending, which as an investor, there's opportunities, good and bad like everything else. And then because of entitlements. All right, so that's Social Security, pensions, things like that. Now, the one thing that you need to understand about this number that's going to blow you away, this 2.3 trillion is not counting the additional stimulus. So right now, there's $1.9 trillion that's already basically made it all the way through, and it's just waiting to be sent out. And so this number doesn't even include the $1.9 trillion. So this number is tiny in comparison. Now, the amount of debt, like I said, we're on a debt-based system, and so we need that debt to continue to grow. But we have been exploding since 1971. It continues just to go up, up, up. Now, I made a recent video talking about the percentage of debt to the economy, and we actually have that in this chart right here I want to show you. And so you can see that debt as a percentage of GDP has only continued to go up and up and up. And of course, it has to go up because that's the way that the system works. Now you can see right here is a pretty key point I talk about all the time, 1971. And that is the year that, do you know? President Richard Nixon took us off of the gold standard. And of course, since then, the debt has only continued to explode, and we're right about here right now. Now, I also talked about in a previous video, I talked about this Keynesian multiplier. And really the Keynesian multiplier comes down when the debt is a percentage of GDP. Now, typically, per the Keynesian multiplier, when debt to GDP is over 90%, it's a big problem. So what that means is that at times when output falls, GDP falls, the government would step in, per Keynesian economics, to spend additional money to get the output back up. And so what you would typically want, let's say that, okay, we have $1 trillion shortfall. They would want to spend half of that, $500 billion, in order to get that $1 trillion that they need to spend. The problem is that once you get over 90%, debt to GDP ratio, you start getting less and less growth. That is the Keynesian multiplier. Now you can see it illustrated in this chart right here. Oops. You can see it illustrated in this chart right here. And so basically what happens is they start tracking together, so the debt is getting the growth that they need. But once you get over 90%, you're not getting the growth. Now, once you get over 90%, you start getting 75 cents of growth for every dollar spent, 50 cents of growth for every dollar spent. And you can see where this diverged right here. And now you can see the debt is exploding while at the same time the growth is staying down. Now we call that the debt death trap. I made a video about that, so I'm not gonna go super deep into that, but you have to understand that so you can understand the next part of where we're going. Now, if that wasn't enough, if the deficit of 2.3 plus the 1.9 that's not even being included, understanding the debt multiplier, the Keynesian multiplier, it's still not enough. Per Janet Yellen, she says that we need to act big. Now, that's after the 1.9 trillion was announced. She said, don't worry about the debt. We'll worry about the debt later because we're gonna get growth out of it, right? But we're not, because we know per the Keynesian multiplier, we're at about 130%, 125 to 130% debt to GDP. So per the Keynesian multiplier, we aren't going to get the debt or the growth out of the debt. She says, don't worry about the debt. We'll worry about that later. We need to act big. Now that's after the 1.9 trillion. Now, if you look at a couple things here, you can see this is from the CBO. This is the budget office, and they've put this together and they show that the updated deficit projection is the 2.3 trillion, as we've talked about, which is 10% of GDP. But like I said, that doesn't even include the 1.9. So we'll probably be closer to 15% of GDP. And the big chart that I want to show you is this one. Now, what's interesting is this is the Federal Reserve's surplus or deficit. Now, do you think they ever get a surplus? Surplus would have more money than you need. No. As a matter of fact, we're pretty much always running in a deficit. We did get a little bit of a surplus right here. But what's interesting, I put these arrows on the screen because this right here is the Great Depression. We barely even noticed the deficit. This right here, World War II. Massive spending, World War II. Barely noticeable, right? Right here, I put this arrow because do you understand what this date is? I just told you, 1971. That is when we got off of the gold standard. And since then, look at the way this deficit has gone down. Now, like I said, in 1929, the Great Depression is a blip. You don't even see it. The World War II, you barely see it. And look at where we are today. So it's important to understand that. Now, this is where the two choices start coming into play, all right? So how does the government fund all that debt? Where do they get the debt from? Who do they borrow it from, right? That's the important piece. Now you have to understand, and I always try to break these complex subjects down to make them very easy to understand, and everything always boils down to supply and demand. It's always supply and demand. So if I want to borrow money, I have to go to the market, and who will loan it to me? If I have really good credit, a lot of people might be willing to give it to me, so I pay a lower rate. If I have bad credit, not as many people will loan to me, I have to pay a higher rate, obviously, right? So that's how even for the government it works. Now, I want to explain something, the debt equals bonds. So a lot of people don't understand what the bond market is. I'm not gonna go super deep into that. You can leave me a comment down below if we need to get a whole video about that. But basically, if you and I borrow debt, we get a credit card, we buy a house, buy a car, that's just debt. But when a corporation or the government wants to take on debt, they issue a bond. So somebody buys that bond, they're basically loaning money to the government. And so who loans money to the government? Of course, who has trillions of dollars to do that? Mostly sovereign governments do, some big institutional players. The problem that we're having right now is that nobody wants to fund the debt. The United States government needs more debt. We have a 2.3 trillion deficit plus the 1.9 plus whatever else they add on this year. So where do they get all that money from? To get the US Treasuries. Now, what we're seeing, again, back to supply and demand, we have the 10-year chart. So the 10-year Treasury is a very key indicator. So I told you there's a couple indicators we're going to watch. So the 10-year indicator is a very powerful one. I like to watch this one because it encompasses an entire business cycle. And we can see that it is going straight up. As a matter of fact, since August of last year, it's basically doubled. Now imagine if your interest rate on your car or your house doubled in about six, 7 months. Imagine what that would do. Now imagine if you had almost $30 trillion. It's a whole different deal. But it's more than what the interest is. It's leading to the choice that they're gonna have to make. So this is the 10-year, this is the Treasury, the 20-year. You can see the exact same thing. So what this is telling us is that nobody wants to loan money to the United States federal government. That's what it's telling us. So this is a deeper fundamental thing that's happening across the world, and it's gonna lead to the choice they're gonna have to make. So nobody wants to loan money, all right? But the other problem, so what happens? All right, I didn't get to finish. So what happens if nobody will fund the government? What do? You might already know, of course, they have to fund it themselves. So if nobody else is going to buy the debt, then we'll just print money and we'll just buy our own debt. It's like a snake eating its tail. And so they're just printing more money and buying more debt, printing more money, buying more debt. But when they do that, it causes another problem, which is the dollar. They start killing the dollar. Now the dollar starts going down. Now you might recognize that home prices are up 20, 30%, depending on where you're at in the country. You might realize that all 3 stock indexes are at all-time highs. Bitcoin's at all-time high. Gold's at, pretty much all-time high. Pretty much everything's all-time high. Any type of recreation stuff, RVs, boats, kayaks, surfboards, bicycles, motorcycles, all-time highs. Food's at all-time high. Basically everything is all-time high. And the reason why they're all getting more expensive is because it's the dollar that's going down. The dollar's losing value. Now, why is the dollar losing value? Same thing, supply and demand. Now, you and I hold the dollars, we get paid in dollars, we pay our bills in dollars, but the US dollar is the reserve currency of the world. You've probably heard that, but do you really understand what that means? It's the reserve currency of the world. So that means that other countries, central banks, are using it for their reserves. You and I, a couple $1,000, couple $100,000, you leave it in your bank. A couple $100 million, couple $100 billion, you don't leave it at Chase Bank or Wells Fargo, right? And so you're putting it into treasuries, which is the reserve currency of the world. And so again, back to supply and demand. Now, to put this chart into perspective, I got this little illustration that's pretty cool. And you can see that US dollars, this was in 2019. It's come down a little bit since then, 2019. But at the time, US dollars were 61% of reserve assets around the world. So all the big institutions, sovereign funds, central banks, etc., of the reserves that they had, of their wealth, about 62% was in dollars, about 5% in Japanese yen, 2.5% Swiss francs, almost 2% in Canadian dollars, and then the rest, little bit. I'm sorry, 20% euros, of course. So 60% dollars, 20% euros, and so forth. Now this is as of 2019, it's come down a little bit. But here's the interesting piece, back to supply and demand. These governments are buying the dollars. But what if they don't want to buy the dollars? If no one's going to buy them, then guess what happens? The value of the dollar drops like a rock. Now, I've talked about the dollar. This is the dollar index, the DXY, and this measures the dollar compared to a basket of other currencies. So it shows how valued it is. Everything has subjective value, and it's all measured against something else. And so the value of the dollar is dropping like a rock. Now you might say, well, Mark, it was a little bit lower right here. And yes, it was. So from about 2016 to 2018, it dropped about the same distance. I've talked about this before. If you've been watching the videos, you probably already know, but this drop right here was a coordinated drop. So the other governments of the world said, hey, US, we're having trouble paying back our debt in US dollars. The dollar is too strong. If you don't weaken the dollar, we're going to default. We're not going to be able to pay that debt. And so through a coordinated thing, through the Shanghai Accord, they decided to devalue the dollar over about 2 years. The difference here is that this isn't coordinated. At least not openly agreed to. And so back to supply and demand, the governments don't want to buy the dollars. And not only that, but the other thing to keep in mind is the time. So not only is it the distance that something goes down, it's also the time frame in which it happens. And so you can see that this fell in about half the time. And so the speed at which it falls and the distance it falls are both super important. And so again, back to supply and demand. Why are the dollars falling? Well, because nobody wants to buy them. Nobody wants to hold them. And so the Federal Reserve is forced to make one of two choices. There's a fork in the road. Which one are they going to choose? Now, the first choice that they have is option number one, which is they can prop up the bond market. They can save the bonds. They can save the treasury market, right? Right now, nobody wants to buy treasuries, so they're falling, and nobody wants to buy dollars, and they're falling. So it's very interesting that they're both falling at the exact same time. So what can the Fed do? They can prop up the bond market. If nobody else is going to buy the bonds, we'll just buy them all, right? So instead of having those interest rates creeping up like they're doing now because there's not enough buyers, the Fed will just step in and they'll start buying them. And because they're bringing more demand, then the yield will start falling back down. And they can do that. They can also implement something called yield curve control. We've talked about this before. And basically they'll buy enough bonds to keep the interest rate, to keep the yield down to a level that they want. Now, when you have, like I said, almost $30 trillion, you can't have the interest rate going up. It'll wreck the entire economy. They can't cover the debt. They'll default on the debt, which they can't do. So they have to keep the interest rates low. And so they'll prop up the bond market by buying the bonds with something called yield curve control, which means, of course, that they're buying all the bonds. That keeps the rates from rising. The problem with that is that it will kill the currency. It'll kill the dollar because they're going to be printing trillions and trillions and trillions and trillions of dollars in order to buy up all the bonds to keep the interest rate down, and that's going to destroy the currency. So that's option one, not a good option. Save the bond market, kill the dollar. The second option that they have, option number two, is they can strengthen the US dollar. They can say, shoot, the US dollar is going way too weak. Prices are running rampant. Nobody can afford a place to live. Nobody can afford food anymore. So let's strengthen the US dollar. Now, in order to strengthen the US dollar, it will then keep its reserve status. I would imagine that the United States Federal Reserve, the United States government would want to keep the US dollar as a reserve status. And so if it continues to drop, the governments will keep dumping more and more currency. So if they can strengthen it, make sure it holds its value more, then it can retain its reserve status and inflation doesn't run so high. That sounds good, right? It holds inflation at bay. The problem with that is then the bond market blows up. If they're not printing the money, they can't buy the bonds. And if they don't buy the bonds, who the heck is going to buy the bonds? You see, it's a tough situation. They're caught between what you might call the proverbial rock and a hard place. Option one, save the bond market. Destroy the currency. Option two, save the currency, destroy the bond market. So which one is it going to be? What is their choice going to be? Well, in my opinion, and it's just my guess, I guess it's my opinion, take it for what it's worth, I believe that they're going to save bonds over dollars. They're going to choose to save the bond market over dollars. The reason why they're going to have to save the bond market is because if the bond market crashes, it would be a systemic crisis. The entire system could come crashing down. The US Treasuries are what they call risk-free assets. It's the most senior level of debt. It underpins the entire global debt-based system that we have. And so if the bond market implodes, which is the senior most debt, it's the senior most collateral, the supposedly 100% risk-free asset, then the entire system collapses at one time. And it's bigger than most people think. And so to give this a little bit of perspective, the dollar, again, being the senior most reserve asset, is also the collateral for the derivatives market. Now, the derivatives market isn't something that you hear a lot about, but it's basically where the the institutions and the banks are out there speculating. They're making bets on everything in the world. And per the BIS, the Bank of International Settlements, which is basically the central bank of all the central banks, they estimate that the derivative market is about $600 trillion. I think I have it up on a chart right here. You can see per the Bank of International Settlements, you can see that for the first half of 2020, they estimated to be about $600 trillion. $600 trillion. Some estimates actually have it to be over a quadrillion, whatever that means, a quadrillion dollars. And so it is a big amount of money. So if they let the bond market go, the entire system collapses, or they save the dollar. Which one would they choose? Of course, that's why I think they'll choose the bond market. Now, of course, I know I've been talking quite a bit about the Great Reset, and of course, if the entire bond market collapses, that would be a massive reset, but I don't think that's exactly the way that it's gonna go down. Now, there is a potential third option. There is a potential third option, but it's something that's way more scary. It's definitely, out of the three, I think they're gonna choose one of the two. There is a third option that's much more scary, but they might opt for it. Now, I don't have time to go into this third option in the video. I'm gonna make it an entire new video. But if you want a little hint, it basically changes the entire structure, which maybe is what the Great Reset wants. If you understand what the Great Reset wants, they want a Great Reset of what? Capitalism. And so they would have to take the entire economy from what's known as a market economy, and they'd have to transform it into what would be known as a command economy. So that would be a reset of capitalism. And again, that's more than I can cover in this one video, but if you know what a market economy and a command economy is, then you probably already know. Leave me a comment and let me know if you want me to make a video about this third option. But right now, the two options are on the table. So what are we gonna do about this? This is big, scary news, and I believe that it is heading towards the climax that we'll probably see this year. Probably maybe by the middle of the year. I mean, they're forced to make these tough choices. Do they want to continue to print stimulus and destroy the currency, or are they going to prop up the bond market? So I believe we're going to have to do that. So what are we going to do? Well, part of it depends on what the choices are. I'm laying out two different choices for you right now, and so it depends on which one they choose. So the first thing we have to do, of course, is that we have to be paying attention, right? So I've laid out the two probabilities. We understand what would have to happen for each of those probabilities to come true. And then we just have to watch and pay attention, and then we have to move and act accordingly. If the inflation is running hot, if they choose to save the bond market, the inflation is going to run hot, and we're going to want to be in assets that protect our inflation. Of course, if they move to save the bond market and let the currency drop, then we want to be in assets that will protect our purchasing power. Now, one good way to play this, and it's the way that I mainly talk about, is we don't have to play the game. We don't even have to play the game. We don't need to be in the financial market playing their silly games. And so we can take our assets out of the financial system and not even play, or we can even just take them out of the United States financial system. So one way to do that, of course, I talk about all the time, is to buy real hard, what I call scarce assets. And so when they're printing an unlimited amount of money, when they're printing trillions and trillions of dollars of fake fiat counterfeit money, it's going to force people to go buy real hard things. Now, I talk about hard assets. When I talk about hard assets, I'm talking about things that cannot be inflated away. I talk about scarce assets. So if you've been watching my channel, you probably know that I recently moved to Puerto Rico, and I put an offer on a beachfront lot. It's on one of the best sections of beach, and it's the last lot that's available. It's a scarce asset. There's not any more beach. Now, of course, somebody can sell one, but there's no more beach being created. They can't create more beachfront property. And so I'm buying that, I'm trying to buy that piece of lot. I have a friend in Austin, Texas, and in Austin, Texas, you probably already know it's the #1 growing area in the entire country, and all the big Fortune 500 companies are moving there. And in Austin, there's Lake Austin, and it's a lake, and there's houses on the lake, but there's only so many houses on the lake, but there's more and more businesses moving there. It's a scarce asset. They can't create more of it. And so what's happening? Well, as those CEOs are moving there, they want to live on the lake, and they're paying more and more money. I have a friend that's there. He bought a house on the lake. Within 30 days, the value went up by $1 million. So that is what a hard, scarce asset is. Of course, gold is a hard, scarce asset. Bitcoin is a hard, scarce asset. A lot of people want to challenge me on that, but in the sense that I'm referring to it as it cannot be inflated, it cannot be manipulated, it cannot be created more of, it is a hard, scarce asset. Another way to not play the game is through emerging markets. Like I said, you can just get out of the United States. And so when these types of situations arise, emerging markets are a really good place to play. Now, that is what to do. Of course, we'll go back, I'll make another video on option 3 and what that means, but that's something much more scary. We'll talk about that. Now, if you really wanna know how to play this, how to navigate this, it's more than I can cover in just this short video, but I am doing a 1-hour training where I'm gonna really break this down into detail. I can't do it on the YouTube video, but there is a link down below. It's a free training. Just click on the link, you get all the details, and I can see you there. All right, so that's what I got for you today. That's what we're talking about. One of two choices. It's coming to a climax probably this year. What do you think the Fed's gonna choose? Save the bond market or save the dollar? Leave me a comment and let me know down below. All right, and that's what I got for you today. To your success, I'm out.